Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Awesome. June 25th, 2026. Weekly research meeting, kind of a different order today. Just be quickly going over this, but first looking at the disclaimer, any prospective or current investors in Canada, just take a look at this. We're not offering securities advice. And then same with the US-based investors. Here's our disclaimer. So just getting into it pretty quickly here. S&P 500 4-box reversal this week. Obviously some weakness in the markets. 1 box from support you can see there. And then 2 boxes from a second straight sell signal. That would be the first time since the onset of that conflict in Iran. But overall, I'd say the market's reversed after the peace deal and SpaceX hype kind of popped the market to begin June, and since then we've kind of pulled back. Overbought, oversold, the lowest since April 3rd. Mag 7 and risk on led the losses this week, so kind of a complete reversal week over week. Same thing with the NASDAQ here, $3 decrease over the week, new sell signal. It's the first since 2 weeks ago. It is $3 from this last line of support, so that's something really important to watch. A highly volatile market action really continues. These mass swings that we're seeing in the mega caps is something that we saw in 2021 and 2022 in meme stocks. These firms are losing $200 to $400 billion in market value in any given day. Just substantial swings that I think are unsustainable, these swings. But nonetheless, still up 15% year to date if you're a NASDAQ 100 investor. Momentum starting to break down, overbought, oversold, lowest since April 3rd. Valuations remain elevated, so continue to watch that. I'll flip through this pretty quickly because the Dow didn't change. Flat week, really. It is rumored that Google is going to join the Dow, so getting even more tech weighting. That's going to join over Verizon. You can see the setup a lot stronger for the Dow, so we'll be watching that. And then the overbought, oversold, still some demand in these value names, 57%, slight decrease week over week, but still very elevated despite the market weakness. And then TSX 60, no box change as well. Very, very weak week for commodities. Obviously, gold pulled back to about $4,000 an ounce. Oil kind of hovering in that $70 range. Just a few weeks ago, it was $90. Markets really being plagued by uncertainty and kind of the peace deal, will there, won't there news. But the TSX still sitting at an all-time high on this chart, still has some elevated demand compared to the S&P and the NASDAQ at 41. And where is that coming from? Some defensive names, including ATD, which I'll talk about a little later. Looking here, the VIX, 4% decrease over the week, a new buy signal, so a bit of a breakup. And you can see this, we've I'd say the VIX has been this year a tale of 3 stories. We've had this substantial increase from that lowest point we'd been at in a few years at the end of last year, and we got this perk up, obviously spiking the highest at the start of this conflict in Iran. Then we got a pretty substantial pullback in the VIX in the months after. And since then, we've created a bit of a bottom and we're making higher lows. And I think that the VIX is going to break out here. So if trends continue, I'd say perhaps position yourself to be a little long volatility. Looking here, bullish percentage charts, S&P 500, as I said, technical indicators really breaking down, pulled back 6%, NYSE, no change. Percent positive trend, no changes here, so I'll just flip through those. And then the Toronto Stock Exchange, the same thing, no changes staying in the 50s. Been in this zone for a few months now. This could pull back, especially with commodity prices breaking down. A lot of changes here in the asset class rankings, with the biggest move commodities, energy actually dropping down to the lowest point it's been at since last October, when kind of oil prices plunged the lowest. Precious metals also sitting pretty low in terms of the buy signal rankings. But down here, currencies, US dollar actually ranking first now for the first time in a few years, after, let's say, some rotation away from some of the precious metals. Kevin Warsh being a little more hawkish than many thought, perhaps hiking rates. US dollar gaining strength this year pretty quickly over the last few months, I'd say. And then within the domestic equities, a lot of movement. You can see energy obviously being the biggest loser this week, but the spread between tech and industrials, which is number 1 and 2, so the spread between tech and the rest, at its largest point in quite a long time, where there's there's over a 50 buy signal difference, and then going even further beyond that, there's 100 buy signal difference between 2 and 3, and that's the biggest difference that I can remember since tracking that chart. Nonetheless, mentioned precious metals. Look, here's gold. This is the spot price, I think. No, this is GLD. But now in red for the first time this year. You can see we've got one last line of support that it created earlier this month, but beyond that, you're going all the way back to November. Obviously, with inflation worries increasing and a number of other factors, there's been a bit of a rotation away from gold, perhaps some profit taking from investors in the new year. Obviously, gold prices and precious metal prices can't continue to go straight up, especially after the year they had last year. But we'll call this a bit of a reset. I think the technical picture still looks murky for gold and silver and platinum, but I think the fundamental story is still there. There's still a lot of net buyers of the precious metals, especially gold right now with the pullback we've seen. Speaking of the entire group of commodities that I was talking about, this is the precious metals group score. Obviously, 6 being the highest, strong buy, 0 being the weakest. We actually dropped below 3.0 for the first time since April of 2024. And actually at the lowest point right now since even before that in February of 2024. So really large pullback we've seen in the last 5 months. We'll have to see if that reverses. You can see here in the past few years, there have been pretty substantial swings in this, from all the way from 1.0 back in 2022 all the way up to 5.0 in the matter of 8 months. So it is possible, but there could be some more downside potential. Looking here, this is the Roundhill Magnificent 7 mentioned in this week's The Weekly Beacon commentary. Talked about Alphabet losing a substantial amount of market value just with 2 employees leaving in the last week that work on their major AI initiatives. But it's not just Google that's obviously been suffering. A lot of these mega cap hyperscalers have seen their stock price pull back in recent weeks. This is the Magnificent 7 ETF that holds just the 7 of those companies. You can see the pullback that it's seen off that May high. Not that substantial, but still about a 10 to 11% pullback, I think, when this chart was grabbed. But there is some nice lines of support, and over the year, Magnificent 7 still up pretty substantially, with Alphabet, I think, still being up about 108% over the last year. So something to note there. And then this is just an interesting chart that I kind of built off the last one. This is the Mag 7 relative performance between the NASDAQ 100 and the Mag 7, so the 6-month spread. Right now, the Mag 7 is underperforming the NASDAQ by 20% over the last 6 months. That's the first time that's ever happened. You can see the relative performance here. Obviously, some periods of great outperformance, where the market's been led by these hyperscalers, these mega caps, and the market's been very top heavy. We've always been commenting on it. Right now, the market is, I'd say, AI heavy, but it's not being really led by these Mag 7 companies, which are already multi-trillion-dollar companies. So something to note there. And then here's just looking at the Mag 7 compared to the S&P and the NASDAQ 100. Their 30-day performance, 60-day, 90-day, 1 year, and 3 year. Obviously, the Mag 7 for the most part underperforming over the short term, these indices, but outperforming in the long run. But you can see the technical attributes here with still a lot of strength in the Mag 7 names, except for Meta and Microsoft, which would be two very hard sells for us right now if we were holders of them. Moving on, private markets, just briefly touch on this. Obviously, this is Joe's forte, but I found this interesting chart. This is, you can see this bar chart is various large private credit funds or BDCs by various sponsors. On the bottom, you can see their Q3 2025, Q4 2025, Q1 2026, Q2 2026 redemption requests. A lot of the Q2 2026 ones haven't been reported, so that's why there's a lot of lacking on the red lines. But you can see for the ones that have reported Q2 26 redemptions, it's grown even more. They continue to flee private credit at a record pace. They want their capital back. And reportedly, more than half of the Q2 requests have come from investors who failed to exit in prior quarters. So this hurting in private markets, I think, is going to continue. And these redemption requests are going to continue to roll forward and compound over time. One of the reasons we're obviously being very stringent when we look at private credit and credit as a whole right now in today's market. A few just more info-based slides. This is just kind of coincides with the crazy run AI and semiconductors have gone on. Taiwan just become the world's 5th largest stock market. In recent months, it's surpassed the market of India, which has, I think, 1.2 billion people, Canada, one of the largest financial markets in the world, and the United Kingdom as well. Taiwan only has 23 million people, so when you put that on a per person basis, it's quite substantial. And this is really the result of a chip monopoly. The Taiwanese and South Korean indices have been the best performing markets in the world, I think, over the last year or two. And that's really been driven by they're heavily exposed. The ETFs are heavily exposed to that trade. And if that's a bit of a sign of a bubble, perhaps it is. But just something very interesting that to note and kind of shows the euphoria of this trade. This is just oil, obviously mentioned oil prices drawing backwards. Obviously, peace deal on the table right now, which has pulled the price of oil back. Oil had kind of been falling in price even in the weeks prior. And one of those reasons we think, other than the U.S. draining their strategic petroleum reserves, is China was doing that as well. Their imports plunged to the lowest level since 2018 as they're relying on their SPR, coal energy, solar, and even nuclear. Chinese demand is also softening. You can see here on the right, Beijing bought in May nearly 40% less crude than it did on average in 2026 prior to May. So a pretty substantial decrease. And that's kind of one of the reasons that the price of oil was kind of kept in check in the month of May and even at the start of June. And that's why I think that we've seen this pretty substantial pullback, even without a definitive peace deal, I guess. And then kind of last slide. This is what I had touched on earlier, one of our longtime holdings. Continue to follow this, continue to purchase this for clients at the right price, at the right multiples, at the right position on the charts. But ATD reported their fiscal year earnings on Monday after the market closed. Really strong numbers overall, very strong quarter, earning and revenue beats, margins expanding. And the overall message that I got from management on the earnings call and the question period is just a return to discipline. They're not going to be looking at these 7-Eleven deals that are going to extremely lever up their company. They want to return capital to shareholders, continue to de-lever their balance sheet. If you look at the market's reaction, up about 12% on Tuesday after this. I think the stock's up about 20, 22, 23% year to date. Yeah, that's right on the bottom. And then on the technical side, it scores very well. It broke out of this multi-year kind of window that it's been trading in. Price target remains 92, which is kind of flat to where it is right now. And it scores out about a 4 out of 5, which is a buy on our side on the technical side. So really strong name. We continue to like it, especially in today's murky markets where these growth names continue to melt up in terms of valuation. And I think that's it for me. So I'll pass it back to the rest of the team.
This is the macro overview, not financial advice. My long biases, still AI, silver, which is just kicking me hard right now, but we'll find out why in a second. Copper, defense, an overall debasement trade, that's not coming yet, but it is definitely coming. And I still have some residual crypto exposure here and there, but it's pretty tiny. I'm still suggesting everybody take a look at hedges. The crypto market continues to be fragile with the risk of breaking, 20 to 50% lower even from here. If we look at the asset classes for the last week, what's really notable, and Ken brought this up as well, is the strength in the US dollar, the largest asset in the world, the contra asset to every financial transaction basically, is on a tear. I mean, it's up over 6% from the lows at the end of January. That is an enormous move, just a staggering move in this space. And we see that, against the rise of the US dollar, all of these other major asset classes are falling. Gold is down, and certainly silver. The demand for silver is still there, but I can tell you the speculative excess is, exited stage left. And that also flows over into, the non-cash flow generating Bitcoin and Ether, which I've just been telling everybody for like months now, just stay away from crypto. And we've seen progress with over 100 ships now exiting the Persian Gulf. I'm not sure who's going to want to take loadings in the Persian Gulf anymore, but we will see. But we are, right now, oil futures are $70. That's pretty amazing. And the S&P's down. Okay. Not much change in economics over the past week. We're now seeing 2 rate hikes being priced into the Fed, which I find that shocking. Like Warsh apparently is looking for ways to, basically say inflation is, not coming. We'll see. Like I'm hearing that they're working on the whole hedonic policy and everything down there. But we see stagflation. Other than that, the major change over the past week is the turbulence in the metals and oil. Here we can see the US dollar just on a tear in the last 2 weeks. I mean, that, from like 99.5 up to, what do we have there? 101.7. It's just an amazing move. And one of the reasons I heard was that people are now paying for oil that they hadn't had to actually pay for over a month now, and it's driving a massive demand for US dollars to close their oil bills. The yen continues to get weaker. Now watch this. I mean, this is beyond where the Bank of Japan has acted in the past. typical interventions, which we can see back at the end of January and again in April, May, are 2 to 4%. It doesn't seem like, well, 2 to 4%, who cares? But the leverage that's used in these foreign exchange transactions, you're talking like 50 times leverage. It's actually astounding. So I don't know how sustainable this weaker yen is going to be. At some point, we're going to be breaking higher to a much higher yen level. I think we could be in the 170s and 180s soon. That will revitalize their exports. Gold continued to be in a bear market. You can see that blue line. That downtrend has not been broken, and things have only gotten worse. We're back to a support level. The next support level would be in the 3,300 range. We're not far from that right now, actually. And, that's when I'm going to take interest in buying gold again. I do think that the Fed is looking for a much weaker dollar, and they will be engineering money printing once the Iran actual deal is signed. And that could be still, 60 to 120 days away before an actual deal gets signed. Remember, we're just working through the memorandum of understanding. Silver, boy, was I wrong. I'm just wrong. It's broken through the support level that I thought it would hang around to 70. We're down below 60 now. Maybe the next support's at 35. This one has just kicked me hard. I thought that the margin revisions would get sorted out and we would get back to seeing some industrial demand, but that just hasn't happened. Maybe the slowdown in China is weighing on it. Oil, supposedly we have a deal. The talks are rocky. Israel is not a part of it. They're still in Lebanon. They're not happy on the ground, that's for sure. They see Iran as having won via negotiation. The heat map has done very well in signaling when to be long oil and when to be out of that oil position. Nothing really new in rates and credit. We're still in a fear market. We were at like 32 last week. We're even more fearful right now at 26. In the short term, it's been a tough week for the S&P, and that gets, the AI trade has a lot to do with that. Like two big models like Kimi and GLM came out of China. They're turning out to be good. Everyone's starting to pivot to what are called loops and using agents. I'm using Hermes agent from OpenClaw, and it's just, it's astounding. And now they've integrated it so that you can use it even with iMessage. The VIX term structure, VIX, spot VIX at 18, and we still have a normal curve. Micron earnings were just unbelievable, like just incredible growth, incredible margins. I was looking to buy some memory yesterday for a new PC, and to upgrade to 64 gigs was going to cost me $1,200 or $1,300, and that's something that 18 months ago probably would have cost $400. There is a massive squeeze on memory, and we're seeing that across all of the Apple products. I tried to price out a high-end Mac, and it looked like it was 12 to 16 weeks before it would arrive, just due to the memory shortage. That, I don't know what's going to happen to Apple, the second largest company in the world. If they can't get memory, I've got to think that the next announcement out of Apple is that they are going to buy their own memory fab. In our triple Q equity regime, we're notably at the day 50 of the current bull. Historically, tends to be about 19 days of one of these types of bull markets. I think we're up 25%ish from that low 50 days ago. And we still look to be in a bull market, even like 5 days out. There's still an 80% probability that we'll continue to be in a bull market based on, this 20 years of triple Q data that we use to create that transition matrix. On the S&P, you can see, we've got 6 of 8 indicators from the shortest term through the yellow midterm or mid-range indicators indicating risk off. The 2 of the longest terms, like we're talking 40, 60 days, they're still green, right? So this kind of looks like a top, but, we saw not a dissimilar pattern just in even like February. Maybe we have a dip, maybe not. Anyway, the math says we're still in a bull market. Now, SpaceX has come off an enormous amount, but let's remember in 1 week, it will be included in the NASDAQ 100. That NASDAQ 100 is going to look ridiculously overvalued at that point. Crypto, just bad. It's a broken risk asset. The only positive news that I have to report is apparently that the Clarity Act is on deck for July 17th. So that, and then if Coinbase can come into the banking fold, we may see some sentiment change for crypto, although the Clarity Act is mainly targeted to stablecoins. Bitcoin still in a bear market, not looking good. We're basically, completely risk off, and that leads to this week's cartoon. Yeah, the boss told me to color all the Bitcoin logos brown from the usual orange. Yeah, so there we go. If it's brown, flush it down. That's it from me.
Okay, thanks, Sean. What I'm going to do here today is I'm just going to take a look at the Strom Capital weekly observations. This just came in, so this is my first time looking at it. Just give me 1 second here. Let's see if I can share my screen. Okay, I hope you guys can see this. Weekly observations here. This is from Michael Coolbaugh, Strom Capital Management. Okay, at the risk of sounding truly foolish, given last night's report from Micron Technology, I still believe the whole cost side of the AI equation is rapidly becoming a major risk to the runaway bull market. Yes, Micron outlined how they have greater visibility into 2027 given their multi-year collaboration agreements with large customers, but this doesn't mean cost has not and will not enter the equation here. So again, cautious here, I think, which is the sentiment that we're seeing. He just kind of concludes here. I wish I could put it in as good of context as Harris Cooperman over at Praetorian Capital. My memory of it is slightly different while I was over at Point State Capital. Okay, so he's quoting Cuppy over here for those who are aware of him. Okay, charts of the week here is looking at S&P 500 consensus expected long-term earnings growth here. Again, kind of just going absolutely parabolic and crazy here. I think this is over 20% earnings growth. And he says consensus expectations are for S&P 500 earnings to grow at 24% per year for the next 5 years. That's nearly double the historical average. This is partially why valuations appear reasonable. But if we look at history, this tends to be more of a contrarian sentiment indicator than it is a true opportunity. Yeah, and the last time we got up this high was, you can see in 2021, before that bear market into 2022. Even pre-COVID, we weren't this high, and even at the dot-com bubble, we were not this high. So things are getting very, very frothy. Margin debt expansion versus contraction indicator here. So we can see again margin debt at this elevated level, similar to 2021 before the 2022 bear market, similar to 08 and similar to 2000. So we're at these elevated frothy levels, not just for earnings growth, but also margin debt expansion here. In Spectrum Tech Inc. DRAM spot price. So this is, I think, in line with what Sean was talking about here. The cost of RAM just going parabolic at this point. And really, this is a relatively new phenomenon. As you can see, this really started only in late last year in October. So, he says the only cure for high prices is high prices here. Weekly usage in 2026 of top 9 models of the Open Router. So this is AI tokens. While investors don't appear to be concerned about cost, actual users are certainly behaving that way. far cheaper models out of China are gaining much more traction than the US homegrown models. And I think yesterday I saw a news story saying that China now has the world's fastest supercomputer. So things are definitely ramping up, in China. Users shift to open weight Chinese models like DeepSeek. Yeah, there we go again. Share of tokens used for US models on Open Router has collapsed. And we can see the comparison year over year. US, this is now, I think, probably half of what it was in June of 2025 compared to now. And China, the DeepSeek, Tencent, Xiaomi, and Minimax models have now more than doubled in terms of share. Software versus semiconductors, so this is IGV versus SMH. How far can the rubber band stretch before it snaps? This would be one epic unwind and likely a major shock to most LS equity funds, long-short equity funds. So he's saying here, the interesting thing about software thesis is that it doesn't matter which model ultimately wins. If agents are running on Claude, GPT, DeepSeek, it doesn't matter. Usage-based revenue models will benefit from agents operating any of these. Looking at the bullish trend, up signal versus bearish trend, you can see his acceleration monitor there. And what I'm reading, economic calendar, this is what he's looking at. Again, this is next week. We talked about this, I believe, briefly in the weekly beacon. So that's already there. And the dashboard legends, risk barometer, there we have it. So that's a disclaimer there. I'm just going to look over my short report here. Give me 1 second. Okay, I hope you guys can see this. A short report for Thursday, June 25th. Quick disclaimer here, S&P 500, again, well above the long-term 200-week exponential moving average that we've seen as the long-term support here in this bull market, going all the way back to 2009 after it broke above it in 2010. What I'm concerned about right now is this sort of consolidation that we've seen. I think Ken did point this out a little bit. Right here, after this strong AI-led rally off of the Iran war lows, we're now essentially going sideways. And we saw previously when we go sideways, what typically happens is we go sideways for some time. And historically, or at least in the near-term history, we need a pullback before we can kind of gather our forces and move a bit higher. This is what happened in March and April of this year. And then again, same thing of last year. I'm not saying that that's exactly what's going to happen, but this stall right now is something that's probably giving investors some pause and asking themselves whether valuations are where they need to be, especially given what we've seen with SpaceX coming in. And as Sean pointed out, yeah, it's given its fundamentals, it's probably going to skew, given its fundamentals and its size, it's probably going to skew the NASDAQ 100 and any other index that it gets into. That being said, as we pointed out, we had 9 straight weeks of positive returns, and historically going all the way back to 1950, when we have 9 straight weeks of positive returns over the near term and even the long term, typically the market does move higher from there, and that is a bullish signal. That being said, CAPE ratio is now still at these elevated levels and approaching what we've seen in 2000 here. So there is cause for concern, especially when it comes to valuations. That said, when we look at 2000, we can see that it actually took a year for it to roll over. So I don't think that we're going to have any sort of melt up panic that's going to precipitate through the market. It looks like if history repeats itself, even if history repeats itself, there will be time to exit. Market breadth, we're seeing market breadth move a little bit higher here in the near term. So stocks trading above their 50-day exponential moving average. Moving a bit higher again towards this danger zone where breadth really is limited. So we want to keep an eye on that. And same thing with the longer term stocks trading above the 200-day exponential moving average. We can see this red zone, which is typically where markets run out of breadth, so to speak. We're starting to approach that. So there is still some room for participation and rotation, which is what we've seen. And we can see long-term NASDAQ growth versus consumer staples. We're right at this. We're approaching right at this high that we saw in 2000 in terms of relative valuations here. So again, we're lots of signals telling us that we're at a market peak or approaching a market peak here. I just want to point out Bitcoin. Sean, I know you talked about Bitcoin here, but yesterday, I believe last night, it made new 2-year lows, cutting under 60,000. It's now just at around 60,000, 61,000. And we can see that, it's had essentially these 3 big waves moving higher. And the concern is that, this is not going to be the next small wave that the 4-year cycle is essentially dead. I don't know if you want to talk about that, but yeah, you've been very bearish about it for some time, and I think rightfully so. This is not yet at the bottom. There's one other thing I want to point out here just very quickly, which is MicroStrategy. So as many of you know, and we've talked about this before, in early 2000, MicroStrategy, which was a software company, I believe, a software as a service company, it was trading around, $20, $15 a share, decided to change its strategy and move to taking all of its cash reserves and converting them into Bitcoin on its balance sheet. And that saw a lot of enthusiasm in the space, and the stock's price quickly went from $20 a share all the way up to $100 a share, as you can see here in early 2021. And that was that previous cycle here. So this one over here, but since then it's continued to move higher and higher. And what it essentially did is they started issuing preferred shares and all kinds of share classes and debt in order to purchase Bitcoin and increase its balance sheet, which then caused the price of Bitcoin to rise, which then caused their share price to rise, which allowed them to then issue more shares. And it was essentially what many people called an infinite money glitch. And the stock went as high as, I believe it got as high as 500 here. This isn't showing on the chart, but it got as far as high, as 500, and now it's unfortunately back to under 100. And it was a infinite money glitch on the way up, and it appears to be an infinite money burn on the way down here, because they have now started selling Bitcoin in order to pay for the dividends of their preferred shares that they've issued that was initially meant to buy to buy Bitcoin. So it's essentially moving on the other way down. This is what I want to point out here. This is not the first time Michael Saylor has gone all the way up and then all the way down. Back in the dot-com bubble, the same sort of thing happened, although it wasn't related to Bitcoin. The stock went as high as $300 a share and then eventually went down to $1, even less than what's shown here, I believe. So that was greater than a 99% decline in the stock. So far right now, the stock is only down about 85% from its highs. But that's not to say that the market cannot punish Michael Saylor and his strategy with more declines here. And the reason I bring this up again is because when we were at this level here, I think it was to the day when MicroStrategy peaked. This was the cover of Forbes, the Bitcoin Alchemist, with Michael Saylor on the cover. And this is interesting because, we've been here before with people being at the cover of Forbes, being essentially frauds in one way or another, or being shown to have brilliance that actually was not brilliant. And so this is, what's this woman's name? Elizabeth Holmes. This is Sam Bankman-Fried. This is Adam Newman from WeWork, and Michael Saylor from Strategy. So if you're concerned about what's happening in the market right now and you have any questions, feel free to reach out to us. We have a solution for downside protection with our partners at Universa, and we'll be happy to talk to you. So that's it for me. Let me just stop my sharing.
Yeah.
Anybody else want to contribute?
On Bitcoin, I still believe in the 4-year cycle, but typically in these crypto winters, we'd be down 75 to 80 something, say 85%. So we're down 50% now, and I would expect that, I'm looking for like 45,000.
Okay.
As Dave noted in previous calls, by the point and figure, it looks like it could go down to 20. One thing that's interesting with MicroStrategy, layer on all of these convoluted converts on top of the equity,
right?
Some of them have just been absolutely crushed in the past month, right? STRC has gone from basically par 100 down to 75 right now. So, anytime I see a company lever up and, it just imperils the equity. So I've been staying away from MicroStrategy. Everything that I'm reading about how Besant, Lutnick, and Warsh intend to deal with the debt means that they need a huge buyer of treasuries, and they need it in the next 12 months. There's an absolute wall of refinancing coming because Yellen famously issued just an absolute ton of T-bills, like very short-term debt, rather than, why they didn't term out to 30 years and beyond when rates were at essentially zero, I have no idea. But now they have to deal with this at a time when China, Europe, like basically nobody wants to show their support of the US by holding their debt. Right? And I do think that at some point when we get past the whole Iran conflict, we will go back to people willing to diversify. The amount of trade going on in the Chinese yuan has notably increased. So this is going to be interesting as to what they do. And the Clarity Act and the Genius Act before that were literally set up so that stable coins under the Genius Act have to be backed 1-to-1 by US dollars or treasuries, right? And you're not going to just hold US dollars. You want to hold treasuries. Tether is the most profitable company in the world per employee by far. We're going to see that increase. So I do believe they are going to get this Clarity Act done, and that'll be in time for, I would expect the turn of Bitcoin to be in October if it comes. But, like my exposure is at an all-time low, other than the private stuff that I can't get rid of. And I just see the market's expensive overall. Jeremy Grantham was making the round saying like, there's a bubble. This is going to be like 10 years of hard times coming. And so I looked up his 7-year forecast. Their forecast for the S&P for US large cap is minus 6% a year for the next 7 years. And it's only, they're only finding value internationally, which I think is kind of true. But like to your points about memory and these, being expensive, when these new models come out that'll be on device, Apple, like you're going to need, 64, 128, you're going to want like 64 gig at a minimum on your phone in RAM. The appetite is astounding for what's needed if this is going to spread out. And I met someone yesterday that does not use ChatGPT, which I found astounding. They hadn't even heard of it. So the penetration is going to come. It's going to drive memory like nothing else.
Sean, just regarding MicroStrategy, do you think that he can get out of this? Because if you look at his obligations, you look at the balance sheet, you look at the dividends that need to be paid, you look at all the different class of shares, is there any way for him to get out of this? Because I just feel as though that, this is going to be a repeat of 2000.
It could be, but remember, he did something I found absolutely disgusting, was he did an equity issue, I think about 6 months ago, that defeased all of the interest payments that they had to make for the next 18 months. Right. Okay. So, and I know some pretty smart guys that have really gone through, there's STRF, STRC, STRK, and STRD. They tore through all of these, understood them intimately. And when they were down in the low 90s, they were buying them up and had a huge gain. And I'm looking at this stuff now. I'll probably give them a call and just say, what are you guys thinking on this? But right now, if Bitcoin goes down to 40,000, yeah, these could just keep going down. And then they would, like September, October, if they were down at these levels or below, things would get quite interesting in terms of like, this could be the deepest value out there.
Because STRC is supposed to be at 100, and I saw yesterday it was at 80, and you just said it's at 75 today, so it just keeps
74, 70 right now, yeah. Like it was basically at 100.
Yeah.
At the end of May.
Yeah. So yeah, I mean, I see this imploding, right? Because he's got his obligations, and as long as the price of the stock goes down, and then Bitcoin's going to go down as well, which I believe his average cost is like $10,000 above where it is now, right? It's high 60s.
Not sure on that, but yeah.
And, in that event, he's going to just have to sell Bitcoin, which is going to push the price even lower. I think he's 4% of all Bitcoin holdings.
Yeah.
So, yeah. Okay. Just wanted your opinion on that. Okay. Not sure anybody else on the call wants to say anything. No? Okay. All right. So thanks everybody for attending the meeting, and we'll see you guys next time. Take care.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.